Welcome to the Silverbridge CPA's Summer Speaker Series. We hope you enjoy this message.
Silverbridge CPA's Summer Speaker Series. My name is Brittany Williams, and I'm Silverbridge CPA's firm administrator. We are very fortunate to have wealth advisor Richard Christensen and financial professional Ryan Snyder, both with Bridgeway Wealth Services, an independent office of Raymond James, here with us tonight, sharing their knowledge on current required minimum distribution, RMD rules, recent changes, and how these changes will affect your retirement income and impact they might have on taxes and estate planning. They will also discuss converting an existing IRA to a Roth IRA and advantages and disadvantages to doing this. I'll introduce them shortly, but just a few items to go over first. If you haven't already, please be sure to mute yourself. You can do so by clicking the microphone in the upper right corner. This presentation is being recorded, so if you don't want to be in it, please turn your camera off now. And then you're also welcome to type your questions as you have them into the chat feature. You can see it up in the kind of top right corner. It's the little bubble that says chat. So just as you have them, you can type them in there. And then when we're done with the presentation, I can go back through and read your questions off. And if we have enough time, we can also open it up, unmute yourself, and you can just ask questions as you have them at the end. And with that said, I will introduce our speakers. Richard became a financial advisor in 1994. Before co-founding Bridgeway Wealth Services in 2009, he was with Merrill Lynch as a senior financial advisor and vice president. His focus includes financial planning, portfolio management, cash management, retirement planning, retirement living, and wealth transfer. Richard graduated from the University of Utah with an MBA and received a Bachelor of Science degree from Brigham Young University in accounting. For almost 28 years, he has enjoyed helping his clients achieve their financial goals. Ryan started his career at Northwestern Mutual, where he worked with clients helping them to achieve their financial goals. At the beginning of this year, he joined the Bridgeway Wealth Services team and is excited to work primarily with individuals nearing retirement. He is a graduate of both Boise State University and Sierra College. Ryan holds a Bachelor's of Business Administration and Finance degree from Boise State University. All right, gentlemen, with that, I will go ahead and turn it over to you.
Great. All right, thank you. So thank you for the kind introduction, Brittany. We'd also like to thank Silverbridge as a whole for inviting us to be here today and to be a resource for anyone who might need it. For those of you joining us, we appreciate your interest in what we have to speak about today. We would also like to commend you on taking the time out of your day to hopefully learn something new here. So our goal is that by the end of this presentation, you will all have a solid understanding of the basics around retirement plan distributions, rules, and strategies. Of course, if you have any questions throughout the presentation, as Brittany already said, we'd be happy to address them at the end, so feel free to jot them down, and we'll get to them then. So Brittany already kind of covered some of this, but I'll touch on it one more time real quickly here. So my name's Ryan Snyder. This is Richard Christensen.
How you doing?
I work with Richard at Bridgeway Wealth Services. I'll go into a little bit more about Bridgeway in just a moment, but in the meantime, here's some contact information that you guys will be seeing on the screen here. Feel free to either jot it down or take a picture for future reference. We often get a lot of questions when we're doing things such as this that are specific to individual circumstances, and we can't really touch on those too much through this type of way of communicating, but we're happy to chat with you for a few minutes, whether that's over the phone or in person. So feel free to reach out to us through the contact information listed there. All right. So our office is Bridgeway Wealth Services. It's located out in Eagle, Idaho. Bridgeway Wealth Services is the name of our establishment, but it's also very important to note that we are an independent branch of Raymond James Financial Services. So Raymond James was founded back in 1962 and has now grown to maintain $1.4 trillion in assets. They're also a Fortune 500 company. As for Bridgeway Wealth Services, that's our office. We were founded back in 2009, as Brittany said, by Richard Christensen and Jerry Scarrow. They both worked nearly 15 years at Merrill Lynch prior to making the move of opening their own branch at Raymond James. All right, so let's kind of dive into the meat of things here. As a baseline for understanding, we're going to walk through some of the different types of retirement plans or accounts. You guys have probably heard of a lot of these before, but still good to just have a solid baseline understanding of everything. So first thing we'll talk about is the traditional IRA. A traditional IRA is generally a tax-deductible or pre-tax account. What this means is that you do not have to pay taxes on the money that you put into the account. However, when you pull the money out of the account, oftentimes that's going to be in retirement, you will be taxed at that point. So there are limited contributions for this type of account. Those limits are usually $6,000 per year, and that will increase up to $7,000 per year once you reach the age of 50. The times where this can be affected is if you are earning less than these contribution limits. If this is the case, then you will only be able to contribute up to the amount that you earn under the $6,000 or $7,000 limit. So if you only earn $5,000 that year, you can only contribute up to $5,000. Next, we have the Roth IRA account. So similar to the traditional IRA, the limits are, they limit the amount that you can contribute. So that's going to be the $6,000 and $7,000 limit. That said, the way that this account is taxed is going to be different than that of the traditional IRA. So remember, the traditional IRAs are taxed when you pull the money out. With a Roth IRA, your contributions are going to be made after tax. This means you're paying the tax upfront. This would also mean that you do not have to pay taxes when the money is withdrawn from the account. Again, oftentimes that's going to be in retirement. So for this reason, these accounts, or the Roth IRAs, are often extremely appealing to those who have many years of investing ahead of them, as their account can continue to grow with the understanding that taxes will not have to be paid once withdrawals begin. All right, and then the last type of retirement plans that I'll be talking about here are employer retirement accounts. So some of the most common accounts include things such as 401ks or 403bs. Many of you have probably heard of these before. These accounts, just like the name says, are often offered through your employer. There is also the possibility that your employer provides you with a choice of how you would prefer the money in this account to be taxed. So the options will either be traditional or Roth. We kind of covered those before. Just as a reminder, the traditional option, as we already mentioned, would allow one to pay taxes upon making withdrawals from the account. The Roth option would allow one to make withdrawals tax-free, as their initial contributions were already made after tax. As with other accounts, your contributions are often limited, but not with the same criteria as the traditional IRA and the Roth IRA. In this case, your contribution limits are going to be determined by the IRS and are often a lot higher. So for example, it's common for contribution limits to be about $20,500 annually if you're under 50 years old, or $27,000 annually if you are 50 years or older. Your employer will also pick a select group of investment options for these accounts. They'll be provided to the employees who are choosing to contribute into the account. So that's pretty much a general overview. This should provide us with a decent baseline of what types of accounts are out there. Next, I'll pass things off to Richard so that he can touch on RMDs.
Great. Hey, well, thanks, Ryan. So we'll talk now about some of the rules and regulations with regarding distributions from your IRA account. And particularly, we'll try to focus on some strategies that might help you for tax purposes. So, of course, everyone has heard of RMDs. RMDs, of course, stand for Required Minimum Distribution. And, of course, this is the minimum amount that the IRS requires you to take out of your IRA account once you hit at now the age of 72. So if you, yeah, the next slide, Ryan, you'll see that for retirees, the age 72 is the key to when you have to start taking required distributions. Previously, you're probably aware that used to be 70 and a half, but in the recent couple years, that was changed to 72. There is an exception to that 72 rule, and that is if you're involved in an employer plan and you still happen to be working for that employer. You don't have to take distributions from that employer plan as long as you're working for that employer and if you own less than 5% of the company. If you are actually an owner of the company, then you're prohibited and you do have to take distributions. There is another item that most people are probably aware of, that the age that you turn 72, that year, you can elect to postpone that distribution into the following year. You would need to take it by April 1st of the following year. But keep in mind, you will still need to take the distribution for age 73 that year also. So you would end up taking 2 distributions in that year. However, that still might be a really good strategy to do, particularly if you were working at age 72 and maybe you had a lot of income that year. It might make sense for you to delay that first distribution and take 2 distributions the next year. And then the last bullet point under retirees, make sure you take your distribution. If you don't, you could be penalized up to 50% of the amount of the distribution. Now let's go to the next column where we talk about beneficiaries. For a spouse, it's pretty simple. The spouse can receive the IRA account and either roll it into an IRA account of their own, or they can keep it in a beneficiary IRA account and just take distributions over their lifetime. For non-spouse, a new rule has been put in place that makes it less tax efficient for most people. And that is the fact that the rule requires now that IRA accounts inherited as of January 2020 have to take all of the money out of the IRA account within a 10-year period of time after the owner's death. So this creates some issues and some things that a person may want to think about from a tax strategy standpoint, and we'll get into that here just a little bit later. You're grandfathered if you have a beneficiary IRA account prior to 2020, and of course, the spouse can continue to stretch out that IRA account over their lifetime. And there are a few exemptions for this 10-year period of time where you can stretch it out. One would be if the beneficiary has a disability or has a chronic illness, or for a minor, the 10-year period of time does not start until the age of majority. So if we go to the next page, it will show how an RMD is calculated. For most people, they're going to use the unified lifetime tables that are provided by the IRS. Really, the only option that I know that is different than this is if you have a spouse that is younger than 10 years. There's another table that you can use for those purposes, but that affects just a real limited number of people. So let's just kind of go through the calculation. So if you go through this table, you'll see that the first column is the age. The next is the distribution period, which is a lifetime expectancy. So let's just go to the age of 75. And let's assume that the IRA account was $100,000. And that the amount of the determination amount is based upon the last day of the year. So on December 31st, this account was worth $100,000. Then you go over to the distribution period and you say at age 75 is 22.9. So all you do is take that $100,000 and divide it by 22.9. And so your required minimum distribution for that year is $4,367. However, if you're 100, you go down to that age and your distribution period is now only 6.3 years. And so you take that $100,000 and divide it by the 6.3, and your required minimum distribution would be 15,873. So at age 100, you basically have to take out 16% of whatever's left in your IRA account. Whereas at age 75, you would just need to take out about 4.3%. So going to the next slide, we'll talk about some strategies with regard to withdrawals. The first three bullet points really kind of have some common themes to them. And that is that you really be aware of the tax brackets and how that affects your withdrawals. And of course, in years where you have lower income, it might make sense to take withdrawals from your IRA account, even if you're not required to. So let's just kind of go to a tax bracket example and we'll talk through that. So here's the tax brackets for 2022. You'll see that you can make up to $83,550, and that is after your deductions, and only be taxed at 12%. So of course, if your taxable income is only $50,000 after deductions, you very well should probably take more money out of your IRA account because you're only going to be taxed at 12%. So if you think that you're going to be in higher income tax brackets in the future, or if you think you're going to need some big lump sums from your IRA accounts in the future that could drive you into higher tax brackets, it very well may make a lot of sense to take money out of your IRA account even before you hit that age of 72. You can see how the tax brackets escalate quite rapidly after $83,550, the marginal tax rate goes clear up to 22%. So be aware of the tax brackets. That's one of the most important things in determining when you should take distributions from your IRA account in excess of the required minimum distribution. So now if we go back to the slide, the fourth bullet point is consider taking withdrawals from your IRA account when the market is down. Let's just kind of go over a possible example. Let's say you own 100 shares of Microsoft in your IRA account, and Microsoft is down 50%. There's a lot of tech stocks right now that probably meet that classification. So it's down 50%, but you really like Microsoft, you think it's going to go up. So one strategy would be to just transfer those shares out of the IRA account into an investment account, but you keep those shares. The transfer amount would be taxable, but now your cost basis would be on the date of the transfer. And then if Microsoft goes up from there, any gain would be treated as a capital gains. And if you hold Microsoft for a year after you transfer out of your IRA account, those gains would be treated as long-term capital gains, which would definitely have preferential tax treatment to them. So again, keep in mind when things are down, when things are not looking good, maybe take advantage of that. And that's when you should take distributions from your IRA account. Another thing to consider is the next two bullet points really talk about making charitable donations from your IRA account, either while you're alive or at death. And we're going to talk about that in a lot more detail here in just a minute. So We talked kind of about tax strategies for retirees. Now let's go to the next slide and talk about tax strategies for beneficiaries. So for beneficiaries, now that a person that inherits an IRA account has to completely liquidate that account within 10 years, there's different strategies that should be considered for both Roth IRA accounts and traditional IRA accounts. For Roth IRA accounts, if that beneficiary does not need the money, it makes perfect sense to just keep the money invested for the entire 10-year period of time and then take a lump sum distribution. That way, it's growing tax-free for the longest possible period of time. However, for a traditional IRA account, it goes back to the tax bracket. Be aware of the tax bracket. And for most people, it's not advantageous to just wait the 10-year period of time and then take a lump sum. It's typically more advantageous to take regular withdrawals so that they stay under the higher tax brackets. So again, the last bullet point, be aware of the tax brackets in all the decisions that you make. Next, we said that we talk about charitable distributions from your IRA account a little bit more. If you have charitable intentions, this is a really powerful way to save on taxes. So there's what's called a QCD, a qualified charitable distribution. And to qualify to be able to do this, you have to be 70 and a half. But you can make distributions to a charity directly from your IRA account. And it can be made to any eligible public charity. And you can do this up to $100,000 a year. And they're talking about raising that and indexing it for inflation. But right now, it's $100,000, which is a pretty sizable amount. And the nice thing is, these distributions from your IRA account meet your required minimum distribution. But most importantly, they're not taxable income. So when you just donate the money to the charity, the money that comes out of your IRA account is not taxable at all. So this might help reduce taxation on your Social Security because now your taxable income is lower. It might help you prevent you from having premium surcharges on your Medicare. But now that there's such a high standard deduction, many people don't get advantage of being able to write off their charitable donations like they did in the past. And this is one way that you can have immediate advantage, even if you take the standard deduction, because it's reducing or not increasing your income by taking a distribution from your IRA account. You can also take qualified charitable distributions from a Roth IRA account, but there's really no tax advantage, so I've really never seen anybody do that, but it is allowed. Okay, so going on to estate planning. Now that you can no longer stretch an IRA account over the beneficiary's lifetime, there might be some strategies that you want to consider for estate planning purposes. One of them might be for you to convert part or all of your traditional IRA account to a Roth IRA account. That way, when it goes to your beneficiaries, it goes tax-free. Those beneficiaries will have another 10 years of tax-free growth. And it can be a very powerful estate planning tool, particularly if you, as the owner of the IRA account, are in a lower income tax bracket than those that will be receiving your IRA account. But of course, another strategy, if you have charitable intentions and want to leave part of your estate to a charity, the IRA is the perfect vehicle to leave to charity. Either all or, of course, part of your IRA can be left to a charitable organization. And when they pull that money out, the charity isn't taxed on any of it. So they get the benefit of the entire amount that is left to them. So that's a few things to think about from a estate planning standpoint. You know, again, we mentioned that maybe converting your IRA account from a traditional IRA account to a Roth IRA account could be something to consider from an estate planning standpoint. But, you know, it might also just be a good idea in general, just from the standpoint where you're leaving tax-free income to your beneficiaries. And again, they have years of growth beyond your death where it can grow tax-free. But also, even if you're not looking at an estate, it may be an important factor, particularly if you're young. I encourage all my clients that you know, are in their 20s, 30s, even early 40s, to convert their traditional IRA accounts to Roth IRA accounts. That way, they have years and years of tax-free growth. So mathematically, it's just a really powerful concept for somebody that is young. So if you have kids, grandkids, or something like that that have IRA accounts, you might just encourage them to convert those traditional IRA accounts to Roth IRA accounts so they can have years of tax-free growth. Because if you're like me, you probably think that tax rates are going up in the future. So it would be good to convert them now where tax rates are lower. And probably if they're young, a lot of times they don't have real high income, or they may have children and a lot of deductions. So it doesn't hurt them that bad from a tax standpoint to do the conversion. So that's kind of what we wanted to cover today. We do, of course, again, want to thank Silverbridge for allowing us this opportunity. It's always important to have wonderful CPAs like that are part of the Silverbridge team. And we're grateful that you guys took some time to listen to us today. And we'll be happy to open it up for any questions. Brittany, are you still there?
She's having some audio issues right now.
Okay.
Brittany, can you hear us? Can you hear me, Brittany?
Looks like she's on mute. Yeah.
Yeah, she had a hard time with her speakers, so I don't see any messages in the chat right now.
I mean, do you want to just open it up, the lines, and see if there's any questions?
Yeah, absolutely. If anybody has some questions, feel free to unmute yourself and ask them directly. Well, I'm hoping we didn't have any other audio issues. I heard you just fine. I'm Robin. So.
Okay, it looks like there's some stuff in the chat here.
Yeah, you're coming in loud and clear, so I'm hearing you.
Yeah, as it says, am I the only one that can't hear Richard?
Yeah, I think the chat was regarding that. Sorry about that.
Did everybody have, was I just speaking to a wall then?
No, no, the rest of us could hear you.
Okay.
It's a great presentation. Appreciate it.
Okay.
Yeah, hi, Richard, and this is Paul. Can you hear me?
Yeah, I sure can.
Yeah, I can. Okay, great. Appreciate the presentation. Sorry, I was a little bit late. So question. So the table that you showed, so you have your IRA, you've got a certain amount you have to withdraw, that's the minimum, like you said. So let's say you pass away before it's all withdrawn. And you may have covered this and I just missed it. So what happens in terms of the beneficiaries? to that amount. I would assume at some point the IRA has to be closed out and then the tax paid on it. Can you explain that a little bit?
Correct. Yeah. So while you're alive, you would go by those tables. And Ryan, you might just go back to that table, the unified, the table that shows the distribution requirements by year.
Yeah, RMDs.
Yeah, right there. So so let's assume that the beneficiary is your spouse.
Yeah.
Your spouse would then just inherit the IRA account, and then she would take distributions based upon his or her age. Okay. However, if it's a non-spouse, then they have a 10-year requirement where from the owner's death, they have 10 years where they can keep the money in the IRA account or take it out. But in the 10th year, it has to be completely liquidated. So that's what we were talking about. If it's a Roth IRA account, typically you want to keep it invested for the whole 10-year period of time and then just take a lump sum at 10 years. But if it's a traditional IRA account, you typically want to take it out gradually so that you're not pulling out all at one time and being in a higher income tax bracket.
Gotcha.
Did that answer your question?
Yeah, it does. Thank you. And so if it's a spouse, the table is set on their age at that time. And
right. So let's just say, correct. Let's just say you're 75, okay? But you pass away at 75, but your spouse is only 72.
Yeah.
Your spouse would start taking distributions on the 72 table.
All right. Thank you. That's very helpful. So obviously for beneficiaries and for like children or whatever, it's good for them to think about and how to manage that as well. So thank you.
Correct.
Yeah.
Yeah, and if you have any individual specific questions, feel free to give us a call.
Sure. Thank you.
Anybody else, or should we just go? I guess Brittany still appears to maybe be having some technical issues.
Yes, it looks that way. Do we have any other questions?
Can you hear me?
I can hear you.
Okay, I'm 70 years old and we just looked and I have one traditional and one Roth. So I'm not very financial. So I think what you're saying showed it might be a good thing for me to go get that traditional converted to a Roth.
Yeah, it might be, depending upon your circumstances. If you are if particularly if you are in a low income tax rate right now, it very well might be worthwhile to convert it. So you kind of just have to look at what your strategy is and what your plan is. If you think you're going to be using that money in the next few years, then maybe you don't convert it, but you make sure you're always aware of where you are on the tax brackets. And so, so maybe you take some money 1 year, you take a portion out of the Roth and then a portion out of the traditional, just so that you don't go into a higher income tax bracket on the money that you're taking out of the traditional IRA account. Sometimes it's nice to have both pots of money.
Okay, so yeah, so.
But it very well might make sense to convert it, particularly if you're, you have estate planning if from an estate planning strategy, it might be worthwhile to convert it. Or if you're in a lower income tax bracket one particular year, it very well might make a lot of sense to convert it.
All right, looks like I got some stuff to figure out. So.
Okay.
Thank you.
Yeah, and if you wanted to go more in depth on that, again, feel free to reach out to us. We'd be happy to hop on a phone call or meet in person and talk with you about it. So.
All right. Thank you guys.
Yeah.
Hey, Richard, this is Chandra.
Yeah, hey, Chandra, how you doing?
Good. Hey, that question made me wonder if the tax bracket's at least not unfavorable. Is there a break-even time frame for when you're like, okay, if you're going to use the money within this amount of years, it makes sense to be looking at conversion? or not to look at conversion versus if you're going to leave it in for a while. Because I do think that's hard to like estimate for me, is the value of getting it in the Roth and then all the earnings being tax-free later too.
Yeah, there's a lot of calculators. In fact, you can just go online and Google Roth conversion calculators and just put in numbers. A lot of it's going to depend upon your tax brackets. A lot of it's going to depend on whether you have to pay, if you have money outside to pay the taxes and not have to use the money that you're converting from your traditional IRA account to pay the taxes. That's a factor. And then, what the factor is that you think you're going to get on the rate of return. Bottom line, I mean, if you're in your early 40s or lower, I think most of the calculators are going to tell you it's good to convert if you have a normal life expectancy. But, it's kind of like one of those things with Social Security. You never know the right answer until you die, is when it was best to take Social Security. This can kind of be the same thing.
Yeah.
So, but there are a lot of calculators and factors. But, younger people, again, in their 40s or lower, it's just really makes a lot of sense to do the conversion usually.
Yeah. Okay, that's helpful.
But yeah, so I know that's not a specific answer, but I would just say, we have calculators that you can look at, and there's calculators online and stuff like that. And again, it just depends upon the factors, but age is the biggest factor.
Yeah. So, and basically meet with your financial advisor and look at your picture and be like, does this make sense for me?
Absolutely. Thanks, Chandra. Anything else, or we don't know where the stock market's going, so don't ask us that.
Well, if there's no more questions, we can wrap it up. Thank you so much, Ryan and Richard, for your information. It was very valuable. Thank you, everyone.
Great.
Thank you.
Thank you for your time, everybody. Have a great evening.
Thank you guys very much.
Thank
Bye.
you.
Thank you for watching this summer speaker series. If you would like to tune in to future presentations or connect with this speaker or Silverbridge CPAs, please visit us online at silverbridgecpas.com.